I'm the director of the risk and the economic and risk analysis department. Get the order right. So we have three very interesting papers, and I would say just as a start to the ones that are presenting and also discussing, if you can quickly say who you are. You know, my name is, I'm whatever you are. And then, and then I would say, here, as you heard from, I think, both Jose Manuel and Cornelia, this is obviously for us a pretty core topic, right? How are bank loans being priced, and is climate risk actually reflected in the pricing of bank loans? So I think that's a pretty core basic question, right? So I should have Roman. Roman, can you hear me?
Yes. And can you hear me?
Yes, we can hear you. Roman, please, the floor is yours.
Oh, thank you. All right, so first of all, I would like to thank the organizers for including this paper into the program. So I'm Roman Goncharenko. I'm an assistant professor at KU Leuven. Now, this paper is titled When Green Meets Green, and it's co-authored with Hans de Greze, Carola Tönnis, and Tamas Vadas, and we're all from KU Leuven. All right, so let me start. Well, by now, all of us know that climate change is threatening the future of the globe, and the extreme weather conditions, even what we see now, it's reasonably hot right now at this time of the year. So these extreme weather conditions attracted policymakers' interest and attention and urged them to take actions. And one of the manifestations of such actions was the ratification of the Paris Agreement at the end of 2015. And the idea of this agreement, of course, is to try to contain, to smooth the effect of pollution on climate. Now, there are estimates that in order to meet these objectives of the Paris Agreement, a lot of money effectively is needed, a lot of investment is needed. So in some way, it is interesting to know, because we see that there's a lot of activities, not just that come from regulators directly, but also initiatives that come from the market, right? So for example, firms and banks participate in various activities where they make various commitments in order to follow a more sustainable path. And the question, a general question that we really have is how these private activities, private efforts, in combination with regulatory policies can affect the cost of financing, when this financing, for example, is channeled to more sustainable firms. All right, so let me state in a little bit clearer way our question and summarize some of our findings right away. So effectively what we do in this paper is we investigate whether and how environmental consciousness we really mean certain attitudes that firms and banks exhibit with regard to environment, right? That they basically are concerned about environment. And for sure, we'll refer to this as a greenness of firms and greenness of banks. So the question is really how environmental consciousness, whether and how it affects the cost of bank loans, right? So our finding in a nutshell is that green firms indeed enjoy cheaper loans, however, only when they borrow from green banks, and only after the ratification of the Paris Agreement. And we refer to this result as a green meets green. So green firms borrowing from green banks, and therefore they enjoy cheaper loans. So our findings thus suggest that for environmental attitudes of banks and firms to actually materialize, to have a real effect on pricing in this context, it might be important that some regulatory actions needs to be taken on the side. So, okay, I'm talking about green firms and green banks. So let me actually explain how we define a green firm, because this is not an easy thing to do, and it's not an obvious thing to do. So we look at the Carbon Disclosure Project, so or for short CDP. Now, since 2008, the CDP annually collects self-reported information about firms' carbon emissions and additional environmental information. Now, our CDP sample covers the period from 2010 to 2018, during which the CDP collected environmental data on about 6,000 firms worldwide. So the ratification of the Paris Agreement is at the end of 2015, so it's nicely lands in the middle of our sample. All right, so what is a green firm for us? A green firm for us is a firm that voluntarily discloses this information to CDP. Now, why do we think that this is enough to think of this firm as green? Because what these firms effectively do, they, on the voluntary basis, measure, manage, and disclose their climate impact. So for us, this is a one way how you can talk about environmental consciousness of firms, right? Now, with green banks, it's a little bit easier. So here we adopt a rather standard approach in the literature. We check if a bank is a part of the United Nations Environmental Programme Financial Initiative. Now, this partnership between UNEP and the global financial sector is meant to mobilize private sector finance for sustainable development, and this UNEP effectively adopts the principle of responsible banking that aims to transform the banking industry to enable it to play a leading role in achieving the goals of Paris Agreement. So at this moment, there's about 160 signatories to this initiative, so 160 banks, and we classify bank as green if it's a member of UNEP. Now, the rest of our data comes from LPC deal scan, because we look at syndicated loans, and the fundamentals on firms and banks come from Compustat Global and North America, Orbis Global, and Bank Focus. So to give you some idea what green firms versus non-green firms in our sample are. So are there substantial differences? And of course there are. In short, typically a green firm is larger, it has slightly higher return on assets, it has a little bit lower leverage, has higher interest coverage ratio, and it's less likely to be listed. Now, so here, of course, there is, as I say, there's a profile of green firms and non-green firms is a little bit different. When we look at the profiles of green and non-green banks, however, there is not a significant difference here. Well, we can say that on average, green banks, those that are signatories to the UNEP initiative, they are a little bit. All right, so let me go directly into our econometric model, right? So what exactly do we do? We estimate the following linear model, where the dependent variable here, this is all in spread drawn of loan of a facility I issued, issued either by the bank B, if the unit of observation is a bank, or by a facility, right? Because typically this is syndicated loans, they're issued by a number of banks, by a facility where you can have multiple arrangements, right? And issued in date T. Now, of course, for us, the main question is we're up to the effect of what's the effect on credit, on the cost of credit when a green firm borrows from a green bank, right? Now, the green firm, as I told you before, is measured by the proxy F green, which is whether the firm reports to CDP, then F green is 1. If it doesn't report, it's 0. D green is the proxy for the greenness of the bank, and the interaction of F green and B green really captures the green mid-green effect, right? It's if you think of this coefficient beta 3 next to the interaction between F green and B green, if beta 3 is negative, then a green firm borrowing from a green bank enjoys that additional discount, which is beta 3. All right. So now, again, this model can be estimated, this equation can be estimated at different levels, depending on what the unit of observation B is. Whether it's a syndicate, in which case we control for average, we take average across the lead of arrangers of the syndicate, or we can artificially expand our data by duplicating those observations where the syndicate consists of multiple lead arrangers, and so treating these loans, duplicating them, and for example, you have 2 lead arrangers, and you duplicate it twice, this observation, but you control for each lead arranger separately. Now, the reason you would like to do it is because in that case, you can also control for time times bank effects. All right. Now, of course, when we think about this green effect, in order for this effect to be present in the data, it's important that the public awareness of climate transition risk is sufficiently high. And our conjecture is that after the ratification of the Paris Agreement, which is the world's first comprehensive climate agreement, the public awareness was raised, right? So in a sense that it increased the risks associated with soft commitments by policymakers and the potential stricter enforcement of climate policy in the future. Therefore, what we do is we estimate that linear equation before and after the ratification of the Paris Agreement. So we split our sample into period before Paris Agreement and after the Paris Agreement, right? And we estimate it for these 2 subsamples. And now I would like to show you our results, right? I hope you can all see this table well. There's a lot of happening here, so let me navigate you through that. Basically, the columns 1 to 4 is when we estimate our model at the facility level. So when the unit of observation B is the facility, in this case, we controlling for the characteristics of the lead arrangers, because there could be multiple ones, we take the average across them. And from the columns 5 to 8 is when we estimate this equation at the individual lead arranger level, so we duplicate data. Now let's just focus on the facility level estimations. For example, let's look at column 1 and 2. Column 1 is the before Paris, so when we estimate our linear model before the Paris, and column 2 is after Paris. Now, if we look at the coefficient of variable of interest, which is the interaction between F green and B green, you can see that before Paris, this beta 3 coefficient is it's positive and statistically insignificant, while after Paris, it turns negative, large in absolute values. This is almost 50 BPS, and it's highly statistically significant. And this result is very robust to various specifications. So, for example, column 3 and 4 offer different specification where we control for more fixed effects, and the lead arranger estimation offers even more robust results because here we control for various time times bank fixed effects and so on. So this table clearly indicates that there's a change, right? After the ratification of the Paris Agreement, we observe the appearance of a strong negative or a discount for loans that are granted by green banks to green firms. Okay. So let me now briefly discuss some of the additional robustness that we performed, just to see that did our results hold. Now, of course, someone can criticize us for performing the sample split, because one could just approach it with a 3-way interaction. So with respect to Paris Agreement, so we also do that, and our results robust to such a specification. We also, it's hard for us to actually identify some real effects to CDP, but we can see that as firms start reporting to CDP, the evaluation that they receive, the score that they receive from CDP improves in time, which somewhat indicates that potentially there is actually an improvement in environmental effect of the firm that starts reporting to. So we also try to do some matching estimators because, of course, the GMG effect might differ on observed statistics, and results also hold when we match on a rich set of firm, lender, loan, and firm times bank level covariates. We also perform the OSTA test for omitted variable bias because the GMG, the green effect, obviously is correlated with some unobserved omitted variables, and that. So,
sorry, Roman, just you have 3 minutes to go, yeah?
Oh, perfect. So we also, of course, understand that the firm's decision to report to CDP is not exogenous, right? It's endogenous decision, and we try to somehow solve this issue by trying to estimate a two-equation specification where, together with the equation that I already showed you, the pricing equation, we also estimate a participation decision, so participation equation of firms for CDP. So it's I will try to control for this endogenous decision to report, and our results also robust to that. We also check because, of course, once Paris Agreement is ratified, you could say, well, maybe the matching changes, right? Maybe firms now know that things changed. There's a rematching between banks and firms. So we ask a question, but if you only look at those matches that were established before the ratification of the Paris Agreement, was there an appearance of the green mid-green effect for those matches? So if you only look at the matches between firms and banks that were created before Paris Agreement, and we project them into the future and just focus on them, and we find that for them too, there is the green mid-green effect. Finally, we also perform a falsification, Paris falsification test, so we cannot replicate our results using random data. Let me conclude. Employing data on syndicated loans over the period of 2011-19, we find that firms that show environmental consciousness enjoy more favorable terms of about 50 to 60 BPS compared to brown firms from Green Bank. Now, this green effect is observed after the Paris Agreement, which is consistent with the impact of increased awareness of the importance of green transition risks. So thank you very much for your attention.
Thank you very much, Roman. So, Serena, you please take the floor. And if I can just say, please stay close to the microphone, or else people online can't hear a word you say, yeah?
Super, I'll try to do my best.
Should say you have 10 minutes.
Okay, so I better start by introducing myself
Yes.
while we get the presentation on screen. I'm Serena Fatica from the Joint Research Center of the European Commission. And let me first of all thank the organizer for having me on the program and giving me the opportunity to read and discuss this very interesting paper by Roman and co-authors. Let me quickly start with my take on the paper, right? Here, the broad research question is whether environmental attitudes matter for the cost of bank credit. And the nice idea, the nice insight from the authors is that they look both at demand and the supply side of bank credit, and this is rather novel. The way they go about it is through an empirical analysis of the cost, so the all-in spread drawn, including fees, of international syndicated loans extended during the period 2011-2019. And as we have heard, they match this loan level information with information on fundamentals for both banks and firms. So what are the main results? First of all, what they term the green meet green effect, the core result of the paper. This simply means that green firms benefit from a discount when they borrow from green banks. But actually, this is true only after the Paris Agreement. And if you want, this is not really surprising, because the Paris Agreement is really a turning point, right, for the awareness of climate risk. There is really a change in perception from the financial sector, from the corporate sector, from the general public of the urgency to act against climate change. What they have also in the final part of the paper is a stylized model where they nicely show that this pricing structure can emerge in a context of third-degree price discrimination. I have comments basically only to the empirical part of the paper, structured in three main areas. First of all, I'll talk about the greenness concept that the authors use. Second, I'll look into what drives the results, and rather more a corollary of the second point, look at specific modeling choices and specific results or coefficient estimates, if you want, right? Okay, let me start with the greenness concept. We have heard green banks in the paper are banks that are subscribing to the UN Environment Programme Finance Initiative, right? I think this is an excellent proxy. We all know how difficult it is to identify green banks, and here clearly for the purpose of the paper you need an ex ante proxy. You cannot look at lending, right? So this is very much okay. What I'm a little bit struggling with while reading the paper is the concept of green firms, right? So green firms are those that voluntarily report to the Carbon Disclosure Project the year before the loan is granted. Now, Roman has nicely mentioned or gone through his presentation by talking about indeed more attitudes or environmental or green consciousness rather than, if you want, greenness, actual greenness per se. And indeed, the point is that the reporting to the CDP captures, in my view, more transparency and disclosure than actual greenness or exposure to transition risk, which is something that is very often mentioned in the narrative of the paper. One simple example, you have firms from the oil and gas sector that are actually reporting to the CDP, right? And you would think that those are really very much exposed to the risk of stranded asset or climate transition risk. Second point related to the first one is about persistence in CDP reporting and also the quality of CDP reporting, right? The idea here, or the point I want to make is precisely this one. Can we take reporting to CDP 1 year, the year before the loan, as a robust indicator of the firm being environmentally conscious or being on a commitment, on a path towards acting or reducing climate risk? The bottom line is why not use a hard measure of greenness, and in this case I'm clearly referring to CO2 emissions. I think, the underlying idea or the elephant in the room is greenwashing. You may have firms reporting to CDP because they want to give a signal to investors or to the general public, but they are actually not really green in the sense we would like to think of when we speak about climate risk or transition risk. Second point, what drives the results? What I miss here a little bit is probably a better characterization of both demand and supply side, right? In the drivers of the green meet green effect. For instance, who are the disclosing firms? For what we said, you're capturing disclosure or transparency with your measure of greenness, but the marginal impact of the additional disclosure to CDP might be different if you are considering listed firms, which are already subject to transparency requirements in other respects, or publishing their sustainability reports with respect to smaller or private firms. By the same token, you could dig a little bit deeper into characterizing who are the lead lenders that you're considering. If it's, I don't know, the usual suspect, a bunch of big banks located in specific countries that have, I don't know, a specific interest in being green or lending to green firms. Related to that, I think the geographic breakdown of borrower or lenders, providing even simply some summary statistics, will help understand what is going on in your sample. I mean, there is evidence that firms are exporting pollution, if you want, so they are moving. They are trying to escape, actually, stricter regulation, environmental regulation, precisely after the Paris Agreement. And there is also evidence that bank credit has moved away has moved across countries following also other policy shocks, like the US withdrawal from the Paris Agreement in 2017. So you may want to better characterize basically what are the channels that are at play in your sample for your results. I would say, related to my previous slides, some more precise comments on the results that you get. So in practice, okay, your focus is on this interaction term, the estimates on the beta for green firms interacted with green banks, but you also have basically a total effect, right, for the corresponding coefficients in the levels. So you have a total effect for a green firm borrowing from a green bank with respect to a brown bank, which is negative throughout. I was a bit attracted by the fact that when you introduce in your modeling equation, I think borrower time fixed effect, the statistical significance of the interaction term weakens a bit. And I was wondering whether then the total effect that you estimate on this is statistically significant in that precise specification. And again, it might have to do with the type of firms that you have in the sample and how they evolve throughout your sample period. Second point on the total effect for a green firm borrowing from a green bank with respect to a brown firm, right? And in this case, this total effect turns out positive when you have your robustness check with the control function approach to account for selection in the CDP reporting. So maybe you may want to look into it a little bit more carefully, or give some explanations in the test that there seem to be in some self-selection. At least this is the impact of controlling for self-selection into CDP reporting. Minor remark, I was wondering, given that you already have your model saturated with quite a few fixed effects, if the type of, the number of loans that you observe allows you to use a bank borrower fixed effect as well to try to identify the effect of changes to the green status, but you already have some robustness on the matching between firm and banks, so this should be taken into account somehow. To sum up, this is a very solid paper. I think it's very carefully executed and has already a number of very convincing robustness checks. And puts forward a very interesting and novel results on the green effect, right? So green concerns seem to be there both on demand and supply side of bank credit, which is, something very good also from a policy perspective looking forward. My two main suggestions are indeed on the way you measure greenness. So I would indeed suggest to use harder measure for greenness, or adjust in parts of the paper the narrative that you currently have, which seems to suggest that you can capture actual exposure to climate risk rather than disclosure and the impact of disclosure and transparency. And the second point relates to a better characterization of the drivers of the results, looking more closely to firms and banks in your sample. Thanks a lot.
Thank you very much. So I'm gonna encourage the people to put their hand up if they have questions, and someone will bring a microphone. And I was going to say, so we have one question at the back, but while we get the microphone shuttled over, Roman, why don't you react to, if you have any immediate reactions, please.
Yes, so first of all, Serena, many thanks for a great discussion. And the points that you raised, they're all valid. Maybe let me quickly respond to the very first one that has to do with how appropriate, let's say, a proxy of greenness is when it comes to the firm. Because, I mean, of course, this is absolutely a fair point. How we measure greenness is by whether firm voluntarily discloses information about, effectively, the information that is related to its greenness. Well, I guess one thing to think about really is when you think about actual greenness, if it's defined in terms of how much you pollute, right? This, in some sense, a kind of book value. It's a retrospective measure of greenness. We wanted to have some measure that would be a little bit more forward-looking, like market value of greenness. And of course, it's possible that firm currently pollutes a lot, but at the same time, it undertakes certain actions or maybe commitments that in a medium or long run will enable this firm to cut on its pollution. That's one thing. The other thing is, of course, the problem is that, as you said, there are certain industries which, by nature, are very polluting. But just disregarding them and saying, well, all firms that come from that industry are equally pollute, well, it's not very good, because then we effectively, these are industry effects, not really firms effects anymore. And of course, we can imagine that even in a gas oil industry, we can have different firms. Some firms would be still relatively more environmentally consciousness. They would maybe make certain investments, again, medium, long run, to reduce their negative impact on environment in the future. And if you think in terms of kind of theoretical models of disclosure, I mean, the vast majority of these models would suggest that it's the better type that discloses, while the bad types, the worst types, typically do not disclose, right? And this disclosure, of course, is about environmental impact. So in a way, one could argue that by disclosing this information, I'm sort of self-select as the one who wants to make changes, or the one who is greener. Now, I, of course, totally understand that this is not perfect. That's the problem, of course, with, in general, with measuring greenness, because if you really go and measure the actual pollution, then, well, it's a more tangible measure, but at the same time, you lose a lot. You don't take into account going to happen in the future. But of course, if you measure the way we do, the possible problem here is greenwashing, right? And of course, we do not rule out the possibility that what is actually happening is a greenwashing, right? At least as it is paper right now, it's very hard for us to argue that this is not greenwashing, right? So we see the effect on pricing that is in the data. It's a very robust result, but whether it's a real effect or whether it's greenwashing, it's harder for us, of course, to say. But again, thank you very much for your discussion. It was very interesting and useful, and a lot for us to think about.
I have one. I have a question from the room, please.
Over here. Hi, my name is Aaron Janowski, and I know that some green banks in your sample heavily use promotional loans from public banks to fund the green lending projects. So I wonder whether these 50 basis points that you measured could be actually come from these credit spread risk that actually these projects don't have to pay because they're funded by promotional loans. Thank you.
Thank you very much for this question. Actually, I have to admit I didn't know about that. Now, my initial reaction would be whether promotional loans does it apply to syndicated loans, because typically syndicated loans are these large loans which are granted by a consortium of banks, but I would definitely like to check it, and thank you very much. So as I understand, the question or the concern is that, look, some of these loans could be just subsidized effectively, right? In this case, because of promotions or something like that. And so that potentially can be picked up in the data. So again, my initial response is I'm not immediately sure that this would apply to syndicated loans, but I would definitely like to check that. And thank you very much for your question.
Well, I have no questions in the chat. I have one from the room, please. We need a microphone up here.
Hello, Dilara Salahova. I have a couple of questions. So first, have you thought about using the forward-looking targets of the firms, and maybe also the ambitions of these forward-looking targets? What about the capital expenditures dedicated to the transition projects? Like something a bit more tangible than just disclosures. And second question, are the banks that you have in your sample also issue the green bonds? So like this, they can also be subsidized by the investors and then subsidize the firms to which they lend. Thank you.
Thank you very much for your question. So with regard to the first question, so a more tangible measure, we are thinking about it. So this is, again, this is a very fair point. The problem, of course, is data availability, right? So it's some of these potential proxies which are more tangible that we had in mind, once you look at the data, you don't have that many observations, unfortunately. So there is a problem with that, but we are thinking about it, and it's a fair question, a fair point. The second question, we are aware, of course, that some banks issue green bonds, but I have to say we never thought about the channel that you just mentioned. So thank you very much for that, and we will definitely think about it, right? Because I understand the point you made about that. On one side, banks can raise cheaper funds by issuing these bonds and simultaneously use the proceeds from issuing these bonds to effectively offer cheaper loans to green firms. Yeah, that's a very nice question. Thank you so much.
So thanks, Roman. Thanks, everyone. Thanks, Irina. Super interesting.